Good afternoon, everybody. It's a real pleasure to be with you. I am Melissa Koide. I'm the founder and CEO of FinRegLab. FinRegLab is a DC-based 501c3 nonprofit research organization. And for those of you who may not know what we do, we undertake empirical research and facilitate dialogue in the context of using new types of data and new technologies in financial services. It is an enormous pleasure to welcome the four of you with me today to join in a discussion about a topic that we know is top of mind for the listeners to this webinar, and we know it's also top of mind for you, and we're looking forward to this conversation. Specifically, really looking at machine learning in financial services, and then honing in on machine learning in the context or the application of credit underwriting. And then we really want to drill down further and talk about the considerations with respect to explainability and understanding some of these more opaque approaches to undertaking credit underwriting of consumers and small businesses. So without further ado, I want to welcome and introduce those of you who are joining me today as panelists, if you will, in this webinar. We are joined today by a set of regulators who have been thinking about these issues for as long as they have been top of mind in the financial sector. To start, I want to thank Donna Murphy for joining us. Donna is the Deputy Comptroller for Compliance Risk Policy at the Office of the Comptroller of the Currency. Donna's role includes overseeing the development of policy and examination procedures relating to consumer compliance, fair lending, the Community Reinvestment Act, the Bank Secrecy Act, and anti-money laundering issues. She serves as a key advisor to the Committee on Bank Supervision and to the Comptroller of the Currency on compliance and CRA matters. And she reports to the Senior Deputy Comptroller for Bank Supervision. Donna, it's great to see you. Thanks for being with us. Apologies, everybody, for the paper shuffle in the background. I also want to thank Carol Evans for joining us today. Carol is the Associate Director for the Division of Consumer and Community Affairs at the Federal Reserve Board. Carol leads several areas dedicated to promoting fair lending, consumer protection, and financial inclusion, as well as leading work with respect to unfair or deceptive acts or practices enforcement, as well as engaging in work with respect to consumer outreach and community reinvestment analyses for mergers and acquisitions. Carol, you'll correct me if I have butchered the categories. Carol is particularly focused on the implications of technological innovation on consumer protection, civil rights, and financial inclusion. And she has written articles in the Federal Reserve Board's Consumer Compliance Outlook publication on fairness in fintech and targeted internet marketing. And for those of you who may not have read the piece that was released last year, it really is informative, and I recommend you go out and find it. Thanks, Carol, for joining us. We're also joined today by Jonathan Miller, who is the Deputy Director for Policy and Analytics in the Division of Depositor and Consumer Protection at the FDIC. Jonathan oversees the development of supervisory policy, guidance, and regulations for FDIC examiners for consumer protection statutes and the Community Reinvestment Act. He also oversees the exam analytics function, which includes the fair lending analyses. He also serves as the designated federal officer of the FDIC's Advisory Committee on Economic Inclusion. And previous to his role with the FDIC, Jonathan worked for the U.S. Congress, including a period of time with the U.S. Senate Committee on Banking, Housing, and Urban Affairs. Jonathan, it's great to see you too. And many of you, I'm sure, are familiar with Patrice Ficklin, who's joining us from the CFPB. She's the director for the Office of Fair Lending and Equal Opportunity at the Consumer Financial Protection Bureau. Patrice is the founding director of the CFPB's Office of Fair Lending and Equal Opportunity, which coordinates the Bureau's efforts to fulfill its responsibilities to ensure fair, equitable, and non-discriminatory access to credit. And again, as many of you I'm sure know, Patrice has played an integral role in various Bureau innovation initiatives such as the issuance of its first no action letter, guidance on alternative financial data, as well as efforts around tech sprints, and one that happened quite recently looking specifically at advances and actions possible with respect to adverse action notices in light of the use of new types of data and technologies being employed in credit underwriting. So it gives you all, I'm sure, a good sense of the level of depth and knowledge these regulators are bringing to this conversation that we're going to be having today around the use of new technologies, machine learning in particular, in financial services, but also especially in credit underwriting. Excuse me. So just to start to really drill down, lots of interest and lots of questions around the use of machine learning models in credit underwriting. And real interest in how much do we need to know and understand, how interpretable do these models need to be when we're employing them in the context of credit underwriting. And so I just want to set the stage first by engaging you all in a conversation about how you're thinking about the use of machine learning generally in financial services. And so just to open us up, Donna and Carol, it would be helpful to hear you all offer some perspective on what you've seen in terms of machine learning in other contexts. For instance, machine learning has been used in fraud analyses for a number of years to detect patterns, whether it's credit card transactions or other fraud indicators. What particular uses of machine learning are you focused on among the entities that you regulate, just to help set the stage? Either one of you are welcome to go first.
Thanks, Melissa. I'll start off. And first of all, I want to say thank you to you and the FinRegLab team for putting this together on this webinar on this very important topic. And I'm really pleased to be here with three colleagues who I've worked with a lot for many years, and always enjoyed discussion and learn something when we talk. So hopefully it'll be a good session. To start off with, as you indicated, the pattern recognition capabilities of machine learning are being utilized in a whole variety of ways across the institutions that the OCC supervises. Not just in the area of fraud detection, although that has certainly been a leader sort of in that area. The ability to monitor a large number of transactions efficiently and to facilitate access to increased data points and sources of information can improve the precision with which decisions are made and recommendations in a variety of areas. For example, effective data mining means that recommended services and products can be more precisely tailored to the needs of targeted customers with respect to pricing, things like that. And the potential benefit of the technologies is that with increased access to these multiple sources of data, in addition to information from traditional credit scoring models, lending decisions can be made more precise, and loan processing times and costs can clearly be reduced. So that's one area we definitely see. As you mentioned, Melissa, my responsibility at the OCC also extends to the Bank Secrecy Act and any money laundering compliance policy at OCC. And we also see many new uses of machine learning to improve effective and efficient compliance in those areas. Certain machine learning techniques, some of the more simple ones like robotics and things can be used to reduce compliance costs and associated regulatory burden with respect to suspicious activity monitoring, customer due diligence, which are two compliance areas that have long presented some challenges for banks. For example, we see in the BSA AML area the use of machine learning models sometimes to better segment customers for determination as to the level of risk of money laundering in their activities. And just to give an example of what that means for those who may not be immersed in the AML field, a private banking customer traditionally in a bank sort of is one category for BSA AML purposes, but a private bank customer who is a gig employee in Silicon Valley will actually have a very different profile from an investment banker in New York who may also be a private bank customer. And with machine learning techniques, we see some of our banks much better able to segment those customer types and identify their potential risks in the anti-money laundering, terrorist financing space. So that can also help to improve the efficiency and the customer, experience for these banks. So those are just a couple of areas, but I'll maybe pass it off to Carol to add some there.
Thank you so much, Donna, and thank you, Melissa, for organizing this event and inviting us all. And I always want to start with a disclaimer that any comments that I have are my own and do not necessarily reflect the views of the Federal Reserve Board of Governors or the Federal Reserve System, and I think that's probably also true for my colleagues. It's great to be here today, and my focus on machine learning and AI has been primarily focused on loan origination, underwriting, and pricing. And we do see significant promise for AI and machine learning and loan decisioning. Some of the potential benefits that we see are reducing the cost of underwriting as well as improving the accuracy. And I also add that we're very committed to ensuring that we are promoting beneficial innovation and helping and supporting our institutions to leverage this innovation for the benefit of customers so they can serve them better. We are particularly focused on ensuring that community banks that play such a vital role in serving communities across the country can also leverage technology to better serve their customers as well. And we think that we're best positioned to help facilitate and promote the benefits when we also do keep an eye on the risks to make sure that we can achieve those benefits without anything derailing us along the way. And I know we'll get into this later, but one of the things that we think about when we think about potential derailers is making sure that we're using AI and machine learning in ways that foster financial inclusion and that don't further calcify some of the inequities we're all aware of in society. And I apologize, my cat Cannoli also thinks he's an expert on these topics and is trying to participate in the discussion.
We appreciate that, Carol. We just want to know, does the disclaimer extend to the cat or not?
It does. He speaks only on behalf of himself as well, or I should say whines on behalf of himself.
Fair enough. Welcome, kitty cat. All right, Jonathan, and I want to sort of call out the obvious. I think we are setting the stage for some of the things that we're going to be diving deeper into, including questions back to Donna, some of the remarks you made that exist among the technologists in the financial sector who are adopting some of these technologies. Some of the different applications, I'll just put a pin in this, may require different levels of explainability than others and different kinds of and critiques than others. And we're honing in on what we all realize is a really sensitive and important area when we're using more opaque models, which is credit underwriting. But I do appreciate, making sure that the listeners are also aware of the broad uses of machine learning, and some of the needs for explanation or interpretability may vary according to the different applications. I'd welcome feedback on that now or later. But Carol, you also raise an important point. I mean, we're not only looking at some of these innovations in the models and the explainer technologies in this moment, but we're also thinking about the adoption of these technologies in this economic crisis with respect to the pandemic and what it's done to households and their financial stability, and also this really important focus on equity and racial justice. And Jonathan, I know you have been thinking about inclusion issues for decades. Frankly, I've known you that long, and we've been talking about that matter for as long. And the FDIC has been leading some important work in really trying to understand the financial access needs and engagement that exists or doesn't exist through the Underbanked survey, which you all just released. Would welcome any sort of input you can share about what you're seeing in the data and how that relates to this conversation in this moment that we're in about the technology and the broader environmental circumstances.
Terrific. Thanks. Thanks, Melissa. Thank you and Kelly Cochran and the other staff of FinRegLab as well for the work you're doing generally. I thought the work on the cash flow underwriting was incredibly helpful and a big contribution. And then, of course, on this issue as well. And I just, as an aside, I have to say we're all working in unusual circumstances. And I know that the people, when dogs bark or cats crawl around or kids interrupt and so forth, I think it makes the person whose kid or cat it is maybe a little uncomfortable. But I think it's charming and humanizes what is otherwise a very different kind of relationship. So,
Yeah.
Thanks, Carol. Even though cats make me sneeze.
Good thing it's virtual, Jonathan.
Exactly. And thanks for that question, Melissa. I think it's an incredibly important question. We're seeing the COVID pandemic hit the impact of the COVID pandemic in communities of color versus other communities. The differential there is astounding. We've seen uneven economic recovery in those varied communities. We saw over some months ago the horrific murders of George Floyd and Breonna Taylor and many others, and we saw a broad-based and persistent reaction to those injustices. And I think all that serves to underscore the need to address these long-standing economic inequities with regards to economic opportunity and access to credit, which is needed to build wealth in this country and has been for a long time. And so I think for us at the FDIC, the first step on the ladder financial inclusion is access and participation in the mainstream banking system. You mentioned our household survey, which the title is now How America Banks. We just released it a week or two ago, and the data were all collected in 2019. So in some sense now it's a little bit of a historic artifact because the data was collected prior to the pandemic hitting. But what it was showing at that point was an overall reduction in the unbanked rate to 5.4% for American households. That's the lowest it's been since we started doing the survey, and that's a terrific outcome. We saw the unbanked rate decline for pretty much every major group. Black Americans, Hispanic Americans went considerably down to, I think, 3 percentage points and 2 percentage points respectively, although the unbanked rates for Black Americans and Hispanic Americans are still much higher than for white Americans. I think very relevant to this general conversation of the use of technology in banking, mobile access to banking, or I should say, the most predominant way that consumers access their bank accounts now is through mobile technology. However, for elderly, lower income, rural households, and even for households whose primary method is mobile, there is considerable use of bank branches, or was in as of 2019. Still, people in certain circumstances walk into a branch. They want to talk to somebody, whether it's to open an account, get a loan, whatever. Bank branches are still in high use, especially for the kinds of populations that are tend to be more vulnerable. So to bring it around to the specific topic of the conversation here, as Carol said, I think financial innovation such as machine learning and artificial intelligence, carefully developed, carefully implemented, carefully managed, can play a role in addressing that access gap, access to banking, access to credit, and therefore access to building wealth. I think it's got to be done carefully and correctly. And I think and I'll sort of again, agree with Carol in saying that we are particularly at the FDIC focused on helping community banks figure out how to get access to that technology in order to be able to participate and contribute to this closing this gap as well.
That's great. That's really helpful context too, Jonathan. Thank you. And I know we're going to come back to the ways that the FDIC and the other regulators are trying to support that engagement by the smaller institutions towards the end of our conversation. So now let's really start to hone in on machine learning and regulatory questions. And I'm going to go so far as to say regulatory expectations when we're talking about using new techniques for underwriting in the models, as well as new types of data. We recognize machine learning. The academic literature indicates it not only may be helpful in the context of prudently, accurately assessing risk among populations who may traditionally be left out of credit access. Open question what it does in the context of price. There's actually some really important research and work to do there. And so it may have inclusion benefits. And as a policy objective, I think we all share that. When it comes to deploying these more opaque models, there are existing laws and regulations that require some level of explainability. But let's just spend a little bit of time talking about those different regulatory expectations. I'll name them, but I know you all are the experts and we'll dive into them, and it'll be important for everybody to hear from you on that. Obviously, the first is just model governance, right? From a prudential and safety and soundness standpoint, do your models maintain robustness and stability over time? There is also the important need to communicate out when there are decisions or adverse actions that arise from what a model generates that have to be both communicated to the consumer, but also known and understood in the regulatory context. And then, of course, really importantly, fairness, in particular, fair lending expectations. So, Patrice, we haven't heard from you. It would be wonderful to hear you just tell us sort of how you're thinking about the major considerations you all are thinking through on the expectations around fairness and disparate impact in the context of these models.
Yeah, thanks so much, Melissa. And let me just start off by thanking you and Kelly and Aaron and all the others at FinRegLab bringing us together and for including me in this important conversation. You know, I think in terms of the CFPB, the Consumer Financial Protection Bureau, it's really important to note that in some ways this notion of innovation and inclusion is really, in a sense, baked into our DNA. We, as many of you know, who are watching this podcast, were created in the wake of the Great Recession and developed really as a 21st century agency. The Dodd-Frank Wall Street Reform and Consumer Financial Protection Act established us with both fair lending and innovation components. And specifically, the Dodd-Frank Act indicates that the CFPB is charged with ensuring that consumers are protected from unfair, deceptive, or abusive acts or practices and from discrimination, but also that markets for consumer financial services and products operate transparently and efficiently to facilitate both access and innovation. In addition, under the law, we're required to provide oversight and enforcement of federal fair lending laws in order to ensure fair, equitable, and non-discriminatory access to credit for individuals and communities. We've done some research, as you're well aware, with regard to underserved consumers, many of whom we dub as credit invisible. And we at the Bureau do believe that innovation, and specifically for purposes of this conversation, machine learning algorithms do have the potential to expand access to credit for some of those approximately 45 million Americans that are credit invisible or who have thin or no credit files. We do believe that these machine learning algorithms have the potential to make underwriting and pricing models more efficient, leading to faster decision times and potentially reducing the cost of credit. But we also caution that machine learning and the use of alternative data can create or amplify risks, including the risks of unlawful discrimination, a lack of transparency, or privacy concerns, as were touched on earlier.
Really helpful. Donna, There could be, and I think you will dissuade listeners, some question of sort of synergies between consumer protection goals and safety and soundness goals. And it would be helpful because you sit in a really important position of thinking about both of those, not just in the credit underwriting space, but in other areas as well. Can you share your perspective on where there are these synergies between consumer protection goals and safety and soundness expectations, especially with the models themselves, and how that plays out in the context of these machine learning models?
So thanks, Melissa, for that question. I think that's an area that I actually do talk about a lot is, the OCC as the, prudential regulator for the national banks and federal savings associations, has been around for a long time. Actually, when Patrice says the CFPB is the 21st century agency, I always joke that we're the 19th century agency, right? Obviously safety and soundness and prudential regulation is a core mission of the OCC, along with ensuring fair access, fair treatment, and compliance with laws and regs. And I think that really a key lesson that we've learned based on historical experience, including the 2008 crisis, of course, it is really the importance of recognizing and focusing on the interconnectedness of the different risk areas of the issues relating to safety and soundness and consumer protection. And so that's something that we have, I think, really focused on, particularly in this crisis that we're in now, since the pandemic started, is making sure that we are looking holistically at those issues as they arise. And for example, if the audience looks at the websites of probably any of our agencies, but particularly in the OCC, we've issued quite a number of guidance documents since March that address various aspects of the COVID-19 pandemic and its impact on both banks and customers. And in many of those documents, where appropriate, we have addressed those issues consistently and addressed the interconnectedness in terms of, even starting with our first bulletin related to working with customers affected by coronavirus and regulatory assistance in March. Ensuring that we're looking at both the consumer protection, fair lending, and safety and soundness aspects of these issues, and recognizing that interconnectedness. With regard to model governance specifically, I think that's an area that we have at the OCC one guidance document for model governance that covers all areas, and something that we've been actually spending a lot of time on over the last few years is sort of making sure that trying to make sure it's clear that even though the same principles apply but depending on what type of model you're looking at, there are different ways that a bank is going to be expected to validate and to otherwise ensure strong risk governance with models, depending on what the outcomes are that are sought, whether it's a model to assess fair lending risk or whether it's a model to assess the capital or liquidity risk associated with underwriting. So I think that those issues do cross over. And as we're looking at greater use of artificial intelligence and machine learning based algorithms and models in this area, trying to ensure that we are working across areas and sharing information within the OCC and in terms of guidance for our institutions, that you need to be focused on the different aspects and the different ways that those models can impact both on the prudential aspects of the bank in terms of safety and soundness, and on the customers and the consumers in terms of fair lending and other implications is a key priority and concern for us.
That's really helpful. And the dynamism of the models, the data that are being fed into the models, which I want to turn to because that is an important aspect of thinking about some of these more advanced, if you will, models. It's the potential and what they can produce, what they can optimize for, especially when we're bringing in new types of data. And Carol, I know you've been thinking about some of the benefits and some of the implications, and Jonathan, obviously you have too. You all have, to be fair. But Carol, it would be good to hear from you about what are some of those data complexities and considerations that also arise when we're talking about these regulatory expectations, but also more opaque models plus non-traditional data.
Sure. Thank you so much, Melissa. And I also really appreciate Donna's comments about the synergy between safety and soundness and consumer protection. And we absolutely see that synergy when we talk about data. Certainly, I think the 2008 crisis underscored for all of us that if something's negative for consumers, it's not going to be good for the banks over the long term either. And we do need to approach things holistically. So my colleagues and I regularly talk with our safety and soundness colleagues about model risk issues and about data issues in fintech to make sure that we're understanding each other and that we are also approaching all these issues holistically. We appreciate that for most institutions, they have a model risk management group that's responsible for the models for all purposes. We also want to make sure that we are positioned to communicate effectively to many of those people working within banks that are really working hard to handle these risks as well. From the data perspective, there's three issues that I think are so interesting and important right now that I'd like to highlight. One is has to do with the kinds of data that sometimes are being used in AI and ML models, and that has to do with what I might think of as the softer data with a less obvious nexus to creditworthiness, such as how we shop, how we live our lives, what magazines we like, what we do in our spare time, what our shopping patterns are for browsing the web. And I think that, one of the things that we're seeing is some of those data could raise concerns about calcifying the inequities that we see in the world. Some of them may be correlated with race, national origin, or other prohibited characteristics. And it's also, when we're dealing with really sophisticated models, the interactions between seemingly benign variables may be hard for us to understand at the outset. So you could have a model that uses hundreds or perhaps thousands of data points, and it's conceivable that they're each vetted on their own, but that in the process of the creation and updating of the algorithm, they're interacted in complicated ways that can mimic the effect of racial discrimination. And, as I think you pointed out, that all of us have been doing this kind of work for a long time. And initially, when automated underwriting, for example, was first introduced, one of the main benefits was that it was going to make everything objective. We weren't going to worry so much about a loan officer potentially reflecting unconscious bias and giving more assistance or treating a white applicant more favorably because the same, say, loan-to-value ratios or credit history requirements would be applied consistently through an automated underwriting system or through a credit scoring algorithm. And I think, although there certainly have been some questions about automated underwriting and credit scoring over the years, the notion that they make things a little bit more consistent and objective, I think most of us do agree with. But what we're seeing now is we may be seeing these systems that are using the same kind of soft data that many of us have spent decades discouraging banks from using, like how someone lives their life, what car they drive, what zip code, all those kinds of things. And will those soft data that may reflect unconscious bias be used and combined in a way that automates some of that softer or discretionary bias that we'll work very hard to eradicate? And I think that's something that we all do want to pay attention to and think about as we evaluate new data sources. And as I mentioned, the second issue has to do with the complex interactions of data that may make reviewing models more challenging than potentially the models of I want to say the olden days, but the pre-AI ML days. And the third issue that I just want to highlight with data is we have the potential to use data now to determine what we all will see on the web or what we all may be offered by the various businesses that we may interact with. And some of this is good. It's good that we're more likely to be shown products that we're interested in on the web. It's good if we can have a financial planning service that is giving us recommendations based on our particular needs and circumstances. There's a lot of good there, but here's where there could be potentially a pernicious side, which is if we're all seeing different things on the web and we may be exposed to different credit offers, it really turns on its head that advice we've given to consumers for years to shop around. Because if we all don't have access to the same information or know what other options are there, we may not be able to do that effectively. So that risk of digital steering is, I think, one that we also want to be sensitive to, while also recognizing the value of that can come with tailoring offers to particular.
So that is a perfect segue into the next segment, but I want to put a pin in this. Carol, you talk about this extensively in, it was last year, correct me if I'm wrong,
Yeah.
the Consumer Compliance Outlook publication. When was that released? And we'll note that on our website for people who would like to drill down much further in terms of how you all have thought
Yes.
about that.
I believe the actual release date is the end of 2019, but it may actually be January 2020, but I can also share the link with you.
That would be great. Perfect. So Carol has set us up well. Patrice, do we need machine learning models to be explainable?
Well, the short answer is yes. Yes, indeed, we do. In fact, machine learning should absolutely be explainable, especially as it relates to its use and deployment in credit underwriting. Specifically, machine learning really needs to be explainable enough to assure not only the accuracy of models, but to also prevent and help reveal potential discrimination on a prohibited basis, and also to help identify for consumers the key factors driving credit decisions on their applications as required by adverse action notice provisions. And as industry is continuing to develop tools to accurately explain complex AI decisions, we at the Bureau expect a number of methods will emerge around transparency, explainability, interpretability, and we think that these transparency developments hold great promise to enhance the explainability of AI and facilitate its use for credit underwriting in a manner that's compatible with applicable law and regulation. We actually recently held a tech sprint in that regard to that end as well, which I can speak about more later if folks are interested in. Hearty hello to Cannoli, the cat, who does add much charm to this podcast.
Jonathan?
Melissa, if I may just follow up on Patrice's point, which I think is a really important point. You mentioned that I work Senate. I'm going to read just a sentence or two from the 1976 Senate report that accompanied the law that required that established a requirement to provide an adverse action notice. So the context is that it's discussing the requirement to provide notice of specific reasons for an adverse action. And the reason they did it was that the information would, quote, have a very beneficial educational effect on the credit consuming public and a very beneficial competitive effect on the credit marketplace, end of quote. And then in the final, in the rule that was issued in January 1977, the Fed said basically that if you get a statement that only that the consumer simply fails to meet a minimum score, that has very little educational value. They said, quote, providing more fundamental reasons for adverse action will enhance consumer awareness of the factors that are considered important by credit grantors and often will enable an applicant to correct erroneous information or supplement information in the application, end of quote. So I think it's just really worth keeping in mind the purpose of the adverse action notice is to help the consumer figure out what he or she can do in his or her behavior to improve their position.
No, all three of you have hit on this, right? Which is we all see the richness of the data and how it may help us as individuals, make better financial decisions, improve our likelihood of better pricing. I think you all are all the lawyers among us. There are the legal requirements with respect to adverse action, and then we have these what I call policy aspirations, which is what we're talking about here, which is how that feedback loop may be really instructive for better financial outcomes for any individual. Patrice, it would be good to hear you talk about the tech sprint. I think you were getting input. I didn't get to attend it, but I think you were hearing input on both of those, sort of how to meet the legal requirements and expectations, but also where there may be promise for helping consumers. Can you share a little bit about it?
Absolutely, yes. And that's exactly right. That's a perfect framing. Let me just start out, just for those who are not familiar with the notion of a tech sprint, and talk a little bit about the concept. It's always a little fun to note that really a tech sprint is a more appropriate, regulator appropriate name for what is truly really a hackathon. But of course, most regulators don't really want to announce that they're in fact hosting a hackathon. And so we borrowed the term from our friends at the Great Britain Financial Conduct Authority and dubbed our effort Tech Sprint. And what we did was we gathered a number of stakeholders from lots of different segments, so industry and advocacy and technology, coming together to address compliance challenges. And the Bureau held its first Tech Sprint in October. And there we did focus on adverse action notice requirements, which are required under two very important consumer protection laws. And thanks to Jonathan for reading the legislative history of these requirements, which was really quite powerful to go back to the root of all of this. That the Equal Credit Opportunity Act and the Fair Credit Reporting Act both require that when credit underwriting decisions are unfavorable, or pricing decisions are unfavorable, that creditors must provide consumers with the main reasons for the denial of credit or adverse action. And when that adverse action is based in whole or part on a credit score obtained from a credit reporting agency, and I know a lot of times machine learning is used in credit scoring, the creditors must disclose the key factors that adversely affected the score, as well as the name and contact information of the consumer reporting agency, and as well as additional content. And as Jonathan pointed out, for consumers, adverse action notices are educational because they notify consumers about potential inaccuracies in the information that was used to take the adverse action. And also, as you pointed out, Melissa, educating consumers about how they can improve their chances of being approved for credit in the future. And it was really neat to hear a number of the teams that were presenting their prototypes talk about this notion of advancement and uplift for consumers. So not only educating them, but also helping them, in a sense, achieve stronger and better financial situations. In addition to that, as Jonathan pointed out, another important purpose of adverse action notices is more regulator facing, which is to help prevent and reveal discrimination on a prohibited basis. So we asked the teams that participated in our tech sprint to spend a week working together to rapidly develop prototypes for how adverse action notices might be transformed from where they currently are now, which are often forms with a box that's checked that consumers may not really find very illuminating and are rarely used by regulators in terms of our work in enforcing anti-discrimination laws. And then we had a panel of judges that joined us and evaluated those prototypes based on three criteria: creativity, effectiveness, and readiness for market deployment. What was so exciting is that the 13 teams that participated developed innovative solutions, many of which were usable on a smartphone and accessible on a smartphone, videos, buttons that could click through and allow a consumer to find more information, that were really creative and more consumer-friendly ways of identifying and communicating the principal reasons for adverse action notices. And some of the teams even tackled the challenge of providing those principal reasons when an algorithm, including potentially a machine learning algorithm, was used to take adverse action. And so, and also again, focusing on communication, how to use web-based or mobile interactive media in order to educate consumers. So the Bureau remains in dialogue with those 13 teams and are hopeful that some of them will consider actually bringing some of their ideas to market, perhaps using our innovation programs, such as our trial disclosure program, our no action letter program, or our compliance assistance sandbox.
I don't know the answer to this, Patrice. Is that, are the sort of learnings or takeaways public, or will they be made public so that others can learn what some of those ideas were that were generated?
Absolutely. They're not yet public, but we're in the process of synthesizing and interviewing each of the teams so that we'll be able to put information and materials on our website as well, because there's some very exciting learnings. I had the honor of actually awarding the prizes for best in creativity, effectiveness, and market deployment, and I have to say the judges really wrestled with their decisions in terms of the awards, because all 13 submissions were really quite impressive. So we look forward to sharing that more broadly.
Great, that's great. Donna, explainability. How do you think about the need for explainability? And I'm not digressing into explainability versus interpretability, and they're emerging definitions. But just as a general matter, thinking about both safety and soundness and consumer protection, any perspective you would share with us as you think about, are there places where we need greater explainability, an understanding of how more opaque models are generating the outcomes that they generate? How do you think about that?
Yeah, so I think that to take this at a slightly higher level than the really interesting discussion of the adverse action notices. I think explainability applies sort of across the board with models, not just to those in that are being developed now with artificial intelligence and machine learning, but it really goes back to the expectation from a regulatory perspective that a bank is going to be able to explain to us, to tell us, how does this model, both the inputs, the methodology, and the outputs, how do they help to achieve the outcome that the model is designed to achieve? Whether it's identifying potential discrimination, suspicious transactions, fraud, across the board, or in the credit underwriting space, whether it's designed to actually improve the ability to predict a customer's performance on the loan. And that how question is really the sort of bottom line on that. And it needs to consider, and we expect, the explainability should consider the inputs, as I mentioned, as well as the outputs. So I think Carol and others have mentioned the data governance issues here. One of the things that is a big issue with respect to, not only the new models, but also some traditional ones, is what is the quality of the data that you're putting into the model? How does the model compensate if there are data gaps or data issues with it? How is that process? And for machine learning type models, particularly, what is the training, that's been done on that model? How has that model been trained to assess the data that's being put into it? And without getting into a lot of technical details, which I'm not the right person to talk about, as I understand it, it's basically there are lots of different ways that models can be trained, that machine learning models can be trained. Some of them are supervised, some of them are unsupervised. Unsupervised models are going to be very difficult for anyone to explain how they actually got to the solution. So the supervised models, are developed, and there's all kinds of advances going on that do make it, pretty readily explainable how the data was addressed, what the methodology was, and how the outcomes were arrived at. But that's really sort of maybe sort of a three-step process. Those three stages, I think, are what we're looking for. Transparency in that, and from a supervisor perspective, from a bank supervisor perspective, it's really critical that the bank officials be able to explain to their regulators how this happens, because if they can't explain it to us, then do they really understand for themselves how it's working? And I think Jonathan earlier mentioned the issue of community banks and smaller institutions, and the real focus on trying to make sure that they can benefit from these technology improvements. And one of the things we work a lot with, our examiners work a lot with the institutions we supervise, to ensure they understand that if they're purchasing or bringing in a third party to implement one of these models, they need to make sure that they're their contracts provide for it, that they're asking the right questions, that there's a lot of work that can be done on the front end to help with the explainability on the back end. And so it's a really, as I think you asked Patrice, yes, no question, is explainability important? It's like, yes.
Yes.
That's really helpful. And I mean, it goes without saying, yes, you all have been thinking about this for as long as I'm sure your institutions have been approaching you about these new techniques. On the other hand, it does feel like the industry, the advocacy community, academics, we really are at the beginning of understanding how do these models work, different machine learning models. Some are much more opaque, much more complex. How do the explainer technologies apply sufficiently? How do you think about that in the different applications that we're all talking about? We're really early days, I think, in building this out. So just to start to wrap us up,
Melissa, if I could add one more point on that, your comment just made me think about the fact that the training of the employees at the financial institution to deal with these the models is and to be able to understand and explain them is really critical. And that's just to, I don't want to leave that topic without adding that point.
And now I'm going to go back at all of you. How are you all dealing with that? I know we didn't prep for this question, but I know each of your agencies are really trying to push to think about, the training, the staffing, the knowledge that's going to be required to really be able to regulate and embrace this. Anything any of you would share on that front would be great. I know the tech sprints are an important sort of first start to that too.
Yeah. No, that's a great question, because in terms of innovation happening, starting to really think about how we position ourselves as regulators is important as well, right? And so it requires us to think about it. And I guess I'll start with just an observation about the fact that we have some practice with this, right? Because we've been here before. And I think many of us can remember when automated underwriting was touted as the solution to, all of the fairness, equity, and discrimination concerns in lending. And that there was a whole notion that if automated underwriting were implemented, it would eliminate the bias that was potentially inherent in human decision making, because a machine would be making those decisions rather than a person. But what we've learned since that time is that automated underwriting can in fact drive discrimination, and as bias can be unintentionally incorporated into the system. And so the use of AI ML models in some ways is kind of, a bit like Back to the Future, right? Because it's really an upgrade of the machine, the automated underwriting system, but it carries the same concerns as automated underwriting does, of bias and discrimination being unintentionally incorporated into the system. Thinking about Carol's comments about the challenges with regard to data being biased, and also Donna's powerful point about supervised models. There's still an important role for human oversight and human intervention. And I'll say that, in terms of the Bureau's ways of sort of getting our arms around this, part of what we've been doing is a little bit of that old sort of buy, borrow, build model of, hiring folks to come into the Bureau with specific knowledge and expertise in AI and ML, borrowing, in terms of collaborating with our sister agencies to do things like produce the interagency alternative data statement that we all worked on last year. Everyone who's on this, all the regulators on this panel worked hard on that. Mm-hmm. And then also in terms of building our own expertise and learning from the work that you guys at FinRegLab and others are doing, and to hearing your perspectives, consumer advocates and industry folks as well, in terms of developments with regard to AI ML, in order to get ourselves in a position to intelligently regulate these types of innovative developments.
Melissa, I have a comment to add on the point too about expertise and how we all develop it. One point that I really emphasize to institutions that I think is so critical when banks or fintechs are thinking about ensuring that they're positioned to have the right expertise, I think it's critical to emphasize diversity and inclusion. If a firm wants to be positioned to identify advantages of technology in markets, as well as to identify risks. It's so critical to have a culture-wide, firm-wide commitment to diversity and inclusion. And when we think about some situations where AI or alt data has gone awry, there's an off-cited example of a tech company building a hiring model that was only based on, or seemed to be unduly based on male resumes. When some of us hear these things, we think, gosh, what were they thinking? And I think maybe what we should be asking was who was around the table to think about it, and were enough people there? And I think for years, I think we've tried to let firms know that diversity and inclusion really is a strength, and there's a lot of evidence about workplaces that embrace diversity and inclusion performing better. But I think in this area, it's so critical on both the risk side and the business opportunity side.
Yeah, that's really important and really helpful to hear. I know the listeners will appreciate hearing that from you, all of your comments. Jonathan, it would be, and I'm not sure if it's beg, borrowing, or stealing, but we know that you all at the FDIC have really begun to push yourselves and solicit input from stakeholders about, are there ways to, what are the right words here, to contemplate how to bring this technology and insight vis-a-vis the relationships that especially some of the community banks may have with vendors. Can you share a little bit about what you all are thinking about in that context?
Absolutely. Thank you, Melissa. Excuse me. So, like the other agencies here, everybody's thinking about how to help expedite the adoption of innovation, the right kind of innovation carefully. So we recently, and we have a focus in particular as primarily a community bank supervisor and regulator, to focus on how can we help community banks adopt this kind of technology. So we recently asked stakeholders to comment on a new approach to facilitate these kind of technological partnerships for our institutions. We put out an RFI, which is Washington for a request for information, where we propose or lay out a potential public-private standard-setting organization, what we call our SSO. It's not adequate unless there are initials that can be used. So we would have we put out an RFI for an SSO, for a standard setting organization.
This is what I was trying to avoid saying, actually.
I know. And then a certification program that would very much focus on reducing the cost and the friction and uncertainty of identifying these kinds of technology, adopting these kinds of technologies. And so we think of it as a sort of from both sides. For community banks, the cost and challenge of developing the expertise to do all the kind of due diligence that Donna helpfully identified as absolutely necessary, and my other colleagues identified as absolutely necessary for each of the kinds of partners they may want to, or each of the kinds of fintech or other organizations they may want to partner with to help keep them competitive or make them more competitive. And from the fintech company's point of view, they've got the cost and difficulty of having 100 banks, each of which may be doing slightly different due diligence, answer this set of questions, this set of questions. So the idea that we're putting forward and asking a lot of questions about, no conclusions have been reached. The idea is essentially to have this standard setting organization, an independent standard setting organization that would develop standards that then the individual companies would get certified as to whether or not they meet those standards, and then the banks who want to hire these companies would have a certain amount of certainty that they met their due diligence requirements and met the standards that are needed to ensure compliance with safety and soundness rules and regulations and statutes, and likewise consumer protection rules and regulations and statutes. So the comment period closed at the end of September. We're reviewing the comments now, and we'll start thinking about what next steps to take there.
That's really helpful. And for those listening, the comment letters are really instructive too. I mean, it's one of the secrets of the RFI process is you really get a sense of where all the different stakeholders are and their, reactions to some of the ideas that regulators put out. So I thought that was fantastic. You put it out for that kind of solicitation.
Yeah, I just to underscore that last point you make. I mean, what I find interesting in this process is you have a real variety of stakeholders commenting, and oftentimes you'll get all the industry stakeholders coming from one point of view, maybe consumer advocacy stakeholders, another point of view, the third parties, a third point of view. But here there is a mix of opinions among even a group of one set of stakeholders. So well worth taking a look. I agree.
Yeah, we'll also make sure to post a link to the FDIC's location for the RFI and the responses. Donna,
Great.
I know you all have been thinking about these matters too in terms of enabling the safe adoption of machine learning. I'm familiar with Project Reach. We had Gravetta on for a podcast a couple of weeks ago talking about that. Is there anything that you would want to make sure the listeners hear in terms of how the OCC is, really trying to enable the safe adoption of some of these technologies and even the alternative data uses? Oop, we can't hear you, Don. Oh, you are on mute. If you can hear us, yeah.
Sorry. Okay. Can you hear me now?
Yep.
All right, great. Well, thank you. Yeah, thank you for that question. I think at the OCC, we actually have a number of different initiatives that are going on to try and facilitate both our, as we talked about a little earlier, our regulatory approach and making sure that we have the right expertise and people to be looking at that, as well as supporting the banks that we supervise in adopting new technologies, as well as other innovative approaches. Our Office of Innovation has been around for a couple of years and has really been on the forefront on a number of these areas, supporting both sides of that equation. And then most recently, Project Reach is an initiative that has a number of different aspects that are designed to facilitate increased access to the financial system by people who have traditionally been shut out. And the OCC really, in that project, really acts as a facilitator for bringing together key stakeholders from the many different groups, as Jonathan was just talking about, industry stakeholders, both banks and non-banks, community and consumer stakeholders, as well as others, in that in the communities and in that sort of environment, to sort of try and facilitate at what we can do and provide sort of real-time regulatory feedback on issues. And there are a couple different work streams, but one of them does specifically focus on, access to credit and the barriers that some people face from the traditional credit reporting and credit scoring system. And, there's some technology aspects to that are being suggested by the participants. There are also some, data aspects in terms of alternative data. And Project Reach is really designed to make sure that the OCC is facilitating that to the best extent that we can. We're not developing any product or anything like that, but we are trying to facilitate those discussions among all the stakeholders to make sure there's a focus on, all the issues there, and to provide whatever regulatory feedback we can on a real-time basis as these projects move forward and support those innovative approaches that can really be helpful, from both a access and a from the industry's perspective, business development perspective.
I think we are about out of time. Goodness knows this is not our last conversation on this matter. So I'm going to say thank you. And on behalf of the FinRegLab team and the names who were mentioned, we are all really, again, appreciative of the fact that you've joined us. So much important work to be done, and it's really lovely to see all of you and to know that you all are working hard on these issues. So more to come, as you know, but thank you all and have a great weekend. And
Thank you very much.
Thank you.
Thank you, Melissa. It's a pleasure. Bye-bye, everybody.